This is Street Signals, a weekly conversation about markets and macro, brought to you by State Street Markets. I'm your host, Tim Graf, head of macro strategy for Europe. Each week, we talk about the latest insights from our award-winning research, as well as the current thinking from our strategists, traders, business leaders, clients, and other experts from financial markets. If you listen to us and like what you're hearing, please subscribe, leave us a good review, get in touch. It all helps us to improve what we offer. With that, here's what's on our minds this week. Summer vacation is now in full swing, at least in the Northern Hemisphere, and as I often do around this time of year, what follows is a short episode on some of the major themes that we're watching across markets as viewed through the lens of our proprietary indicators. I also tend to take a couple of weeks off from the podcast. Let's be honest, I cannot compete with a good beach read, so we're going to move to a bi-weekly cadence of episodes until after the US Labor Day holiday. Anyway, 4 themes stand out to me as important for these coming weeks and as topics where our research has a lot to say. First, the concentration and heavy positioning in the AI and broader tech trade and how flows and price action map to that. Also, how meaningful any changes in financial conditions are to the Warsh Fed now that he's taken over, and also how will he navigate the cross currents of inflation. And will either of those forces be enough to shift policy expectations by a meaningful amount over a meaningful horizon? Third, what do both of those first 2 themes mean for the US yield curve and the dollar? And finally, how does the rest of the risk complex in FX markets fare, specifically looking at higher yielding currencies? Well, let's start with AI and technology stocks. First, couple of facts for you. The institutional investor portfolio weight to equities that we capture at State Street is now at 59%, which is the highest since 2008, and having risen by 3% of total portfolio weight in this year alone. Overweights in global IT stocks dominate this position, and a competing fund manager survey puts the overweight in global semiconductor stocks as the most consensus belief held in their 20-plus years of tracking these things. Our own measure of institutional ownership of semiconductor shares is also pretty extreme, with the off-benchmark weight at an all-time series high as recently as late June. Hedge fund short interest in semis? Guess what? It's almost never been lower. In early June, the off-benchmark weight to Korean stocks, which have sort of become the day traders' go-to exposure to semis, as well as the broader AI story, those were also at all-time highs and nearly double the size of the previous record overweight. None of this should be surprising. Probably every person in markets appreciates that AI and AI-adjacent stocks comprise some of the most crowded consensus longs in history. And depending on your view, despite being earnings machines, most of these stocks are also some degree of expensive. Forward PEs for many of them are between 22 and 25, which isn't insane. But of course, that forward PE embeds in it expectations that might prove to be very, very optimistic. And on a relative PE basis, industries like semis are off the charts expensive. So it is, again, not controversial to posit this as the biggest potential vulnerability for some of the largest pools of capital on the planet. The saving graces are twofold. As my colleague Maria Vateman regularly reminds me, no other sector earns like IT, and semiconductors specifically. In semis, supply still cannot keep up with demand. And in other sectors, the earnings performance is abysmal relative to even a degraded version of the AI trade. So until those factors change, it's hard to see investors losing too much interest or sleep. The second factor and saving grace is that rotation is everything. I regularly write about this in my new publication, The Volatility Current, which you should really check out if you're a client of State Street. To keep it brief and a little less nerdy, index volatility in equities has been suppressed in recent years by the enormity of swings in the performance at a single stock and sector level, which ultimately keeps realized correlation and therefore realized volatility within the index actually counterintuitively quite low. One pocket of the market might be seeing huge outflows and a large correction, and we for sure saw this early this year when software stocks were derated. But as long as capital is rotating, as it did during that period into hardware stocks, the overall index remains calm, even if its constituents are going crazy. What you don't want are investors racing to reduce risk-taking everywhere in highly correlated fashion, and so far, we've been able to avoid that fate. And current flows suggest that is still the mindset. Remember what I said earlier about the overweights in global semis and in markets like Korea as being at extremes as recently as a month, 6 weeks ago? Well, they've actually been subject to tremendous rotation away from them since then, and they're already a lot less crowded with only minimal damage done to the broader indices. One of the bigger beneficiaries of the selling we were seeing in tech hardware as positions were being reduced were significant inflows back into software. Software stocks remain heavily underowned after the selling this year, despite many positive adjacencies to the dominant AI theme. Same goes for the broader communication services sector, where holdings are neutral, valuations actually look kind of cheap, and earnings and return on equity look incredibly solid. The inflows we see are very strong. Bottom line for this theme is it could all still go horribly wrong. Behavior is, of course, fickle. Expectations for tech are still sky high. But the current message from flows and positions suggest it's broadly risk-positive rotation for now, with any pain to be taken later. If it's taken as read that we don't see imminent disruptions to the risky asset complex despite crowding and overvaluation, what does that mean for central bank policy? Especially when inflation is still subject to the swings of input costs that are introduced by the Iran conflict, and as labor markets continue to grapple with the possibility that technology might replace, rather than just augment or improve, the productivity of employed workers. In terms of financial conditions, the Fed, of course, will tell you that they are an important input, but not part of the policy mandate. Given some of the more hawkish messages that we've received at and since the June meeting, it's safe to think that continued health in equity markets, tightness of credit spreads, the relative stability of long-term interest rates, mortgage spreads, and the US dollar, all of these at worst suggest no need to really ease, and maybe even some need to tighten. After all, the wealthiest Americans now contribute a growing share of total consumption, as a hallmark of the K-shaped economy that we've talked about with respect to the US on this podcast many times. Should those Americans' wealth grow, it clearly makes the management of inflation and inflation expectations that much trickier. And recent labor market data might have been slightly disappointing relative to expectations. Labor markets are not necessarily tight, but supply is, of course, constrained by a drastic reduction in immigration. It's commonly believed now that the number of jobs required each month to keep the U.S. unemployment rate steady is somewhere between 0 and 50,000. The number of employees that were on non-farm payrolls this year has grown by an average of 92,000 per month. That's a lot higher. The unemployment rate ticked lower last month, and if these trends continue, it will likely continue to do so. This tight labor supply contributes to a belief that the small easing cycle begun under Jay Powell has now run its course, and that reversal is perhaps imminent. But of course, inflation trends are key, and here we have a bit of good news. Our price stat series for the US and most other countries continues to swing around with oil prices thanks to the ever-shifting headlines out of the Middle East. But the picture of core prices is a more benign one, and our price stats data have done a good job of forecasting some of the downside surprises we've seen in core inflation this year. There's a really long way to go. Services inflation excluding housing, or what we call supercore inflation, this did see a big drop in June, and larger base effects offer the possibility of much more progress back towards 2% over the course of this summer and maybe into early next year. But the broader point within that is that this measure of inflation is still above the Fed's 2% target. And also, Kevin Warsh has talked a lot about preferring measures of inflation that focus more on the mean or median inflation rate of goods within the basket. And those trimmed mean measures are still 2.5, 2.6% year-on-year inflation. And if those narrower measures of inflation are what you're going to hang your hat on, they really need to be around 2% for you to maintain credibility. Perhaps that's why, despite a belief that he'd come in as a dovish Fed chair appointed by a president who wants lower rates, the message from Warsh and the Fed has been taken in much more hawkish terms. We capture this really nicely with our gauges of the tone of central bank coverage in the media, which at one point had the Fed as the most hawkishly covered central bank in the G10. It's not the case anymore. That gauge has since retreated, and it likely will continue to do so after last week's large downside miss in CPI. But it is still hawkishly inclined. And the fact remains that, based on the evidence available, the market pricing for rate hikes this year most likely gets the sign or the direction of travel right, even if the magnitude is still very much up for debate. that hawkish June Fed meeting, the U.S. yield curve flattened sharply, the U.S. dollar strengthened, and briefly broke out of a long-held range. But recent events, especially last week's CPI miss, have taken each of those variables right back to where they started. So where do we go from here? For the U.S. yield curve, we can come at this from two ways. At the front end, at the time that I'm recording this, there's only a modest amount of rate hikes that are priced in now for the remainder of this year and over the next 12 months. More than any real call on how much the Fed might actually hike, this is really just a probability-weighted expectation that their next move is up rather than down at some point, even if not imminently. And absent a shock, that seems pretty reasonable, right? The labor market is doing okay. Jobs are being added at a pace that is in excess of the break-even assumption. Inflation is still a bit sticky above target. And the new Fed chair sounds pretty hawkish if you actually listen to him. So that suggests room for flattening, especially in the spread of 10-year yields to 3-month yields, which has been steepening for 2 years following the initial signals of the 2024 and 2025 easing cycle. But the message from institutions is more mixed. U.S. Treasury flows, which are weighted for duration, show outflows. But there's robust front-end buying, which means overall a bearish bias for rates, but maybe one that is more of a steepener for the curve rather than a flattener. A lot will depend on what the Fed sees as its neutral rate, the rate that balances savings and investment and is consistent with the economy operating at full employment and target inflation. This is a big point of contention, and not just within the Fed, but within the rhetoric of the chair himself. I really recommend going back to last week's episode that I did with Marvin Barth. In campaigning for the job as chairman, Kevin Warsh's language would have suggested that supply-side gains from this productivity boom we're having would lower the neutral rate and maybe allow for more Fed easing. He sounds a lot less sure about that now, and the steady rise in long-term real rates would suggest that market expectations for neutral are rising as well, and that is probably a flattener if the front end starts to catch up. Long-term, that is also most likely good for the dollar, and I've written a lot about the dollar lately, admittedly with some mixed messages. Short run, the risk cycle is really positive, as we've discussed. Our asset allocation process suggests continued outperformance of equities over bonds. The negative correlation that the dollar has had with equities is much stronger now, which also suggests, therefore, dollar weakness, especially against higher yielding EM currencies. I'll come back to those in a bit. Positive US data surprises, those drove that repricing of rate expectations higher, but now the consensus is that the US will continue to outperform. So it's maybe subject to some disappointment. These things cycle in pretty predictable patterns. And institutions continue to sell the dollar aggressively and build an underweight. So for the next few weeks, maybe the rest of the summer, some weakness should maybe be expected. But again, I look a lot at option markets, and the pricing for dollar upside actually looks quite inexpensive against most currencies, except maybe the Japanese yen. This skew in option markets deviates from the big negative correlation we observe between the dollar and risky assets, or more accurately, the positive correlation between the dollar and its own implied volatility. It makes dollar calls look underpriced. And as we also discussed last week, the US productivity cycle is perhaps still in a big upswing, and the forecast errors that often follow typically track the dollar higher over time. Positions, again, are very, very underweight already, and I'm not convinced we get as dovish a Fed as the president wants, at least not based on the chairman's rhetoric since he took over. So that's probably one we should file away for late summer, because I think the short-term dollar losses we might see could be very good long-term buying opportunities. And that leaves us with risky emerging market currencies, which will typically perform as the inverse of the US dollar. Stronger when it weakens, weaker when it strengthens. The good news for those looking for EM exposure is that the asset markets aren't very crowded, and any of the crowding in high-yield currencies is also not apparent. And after years of building inflation-fighting policy credibility during the pandemic, many EM central banks are now in a good position to maybe ease policy from a high rate level, which raises the attraction to local currency bonds. And the yields themselves are still, in many countries, much greater than anything you can earn in developed markets with only modestly higher currency volatility. The best news is that many of the highest yielding currencies in EM are amongst the least crowded, especially Latin America, and particularly Colombia, Brazil, and Mexico. None of these currencies are overweights in our FX holdings measures. Many of the lowest rate currencies that could be used as funders for these longs have big overweight positions that can be sold as funding. In G10, the one that really stands out is the Swiss franc, the lowest yielder of them all. In emerging markets, the Asian exporters like Taiwan, Korea, and China, their currencies all have big overweight positions that can be also sold. Given emerging markets can often go from one extreme to the other, it's rare that we see such mixed positioning as we see currently. So far from being a summer where there's not much to think about, our indicators actually offer plenty of interesting ideas to kick around for the coming 6 weeks. We'll see you back here in August. Thanks for listening to Street Signals. Clients can find this podcast and all of our research at our web portal, Insights. There, you'll be able to find all of our latest thinking on markets, where we leverage our deep experience in research on investor behavior, inflation, media sentiment, and risk, all of which goes into building an award-winning strategy product. And again, if you like what you've heard, please subscribe wherever you get your podcasts and leave us a review. We'll see you next time. Informational purposes only. It is not intended to suggest or recommend any transaction, investment, or investment strategy. It does not constitute investment research, nor does it purport to be comprehensive or intended to replace the exercise of an investor's own careful, independent review and judgment regarding any investment decision. This communication and the information herein does not constitute investment, legal, or tax advice, and is not a solicitation to buy or sell securities or any financial instrument, nor is it intended to constitute a binding contractual arrangement or commitment by State Street of any kind. The information provided does not take into account any particular investment objectives, strategies, investment horizon, or tax status. The views expressed herein are the views of State Street as of the date specified and are subject to change without notice based on market and other conditions. The information provided herein has been obtained from sources believed to be reliable at the time of publication. Nonetheless, we make no representations or assurances that the information is complete or accurate, and you should not place any reliance on said information. State Street hereby disclaims any warranty and all liability, whether arising in contract, tort, or otherwise, for any losses, liabilities, damages, expenses, or costs, either direct, indirect, consequential, special, or punitive, arising from or in connection with any use of this communication and/or the information herein. State Street or its affiliates may from time to time as principal or agent for its own account or for those of its clients have positions in and/or actively trade in financial instruments or other products identical to or economically related to those discussed in this communication. State Street may have a commercial relationship with issuers of financial instruments or other products discussed in this communication. This communication may contain information deemed to be forward-looking statements. These statements are based on assumptions, analyses, and expectations of State Street in light of its experience and perception of historical trends, current conditions, expected future developments, and other factors it believes appropriate under the circumstances. All information is subject to change without notice. This communication or any portion hereof may not be redistributed without the prior written consent of State Street. Past performance is no guarantee of future results.